Hi everybody, it's Thomas with the market summary for the second quarter. You can pause and view any slide in detail if I go too fast. Let's take a real quick look at the one-year chart of the market. This is the S&P 500 exchange traded fund, and this area right here is the second quarter. It was volatile. You can see it started here, ended higher, but had a decline in the middle of the quarter and then rallied towards the end. Third quarter, we're still rallying. We know that in the first quarter we had a big rally after the big drop of the fourth quarter, and that gives us a little bit of context about where we are. So if we go look at the returns for the U.S., developed, foreign, emerging markets, global real estate, and the bond market, you can see that everything was up in the period. Let's concentrate on the U.S., up 4%. The average return is 2%. Best quarter and worst quarter are down here for each of these categories. So the U.S. continues to outperform most other categories, and the market remains very strong. This is a little longer periods. So now we're in the 10th year of a bull market, and we've been in business 16 years. So we had a very steep recession that some of the longer term clients have been through. But for the last 10 years, it's been very, very strong market. And again, for each category, the U.S. is outperforming over almost every period and for almost every category. This is the news during the quarter. It's a mix of good and bad news. And the world stock market is a little more muted than the U.S. because this is all country. But it's the market, despite some bad news, continues to rise and act very strong. This is even over a longer term. That was the quarter, and this is the news for the past year. The inset is for a longer period of time, and it shows the recession, but it's the last 12 months is rising with that big decline during the fourth quarter of last year. So in world asset classes, the types of investments, the S&P large cap U.S. and mostly tech and growth is performing the best in the quarter, and emerging markets was the worst. And for just concentrating on the U.S., growth was leading the way as large tech was doing great again. Small cap and value was doing the worst, although all returns are pretty decent for longer periods of time. And then in international, again, growth was the best. Small stocks and value stocks were trailing relative to growth. And similar, although value was doing the best, returns were really muted for emerging markets. I wanted to pause here and go to another slide, which is, I think most of you know that we overweight. We don't market time and we don't stock pick in our portfolios, but we do overweight certain categories. We overweight small stocks relative to large, and we overweight value stocks relative to growth, and we overweight highly profitable companies to less profitable companies. So that's where we try to find outperformance. And this little slide says that in 7 of the last 10 years, the value premium, value stocks versus growth, has been negative. And it's described here. This is by year. These bars above the line are outperformance. Bars below the line are underperformance. For the last 10 years, we've had a bunch of underperformance in value. But you can tell going back in time, which is why we endure with this, even though over periods we can have underperformance, we're hanging on. The next slide basically breaks it down into 10-year rolling periods instead of 1-year periods. And over 10-year rolling periods, the best performance was back in from 40 to 50. And then good performance is spread out all over time. And you can see just from the graphic that over 10-year periods, value outperforms growth. And there's only 13 instances of underperformance. And we're in one right now, this current period that we're in right now. So do we, abandon that? And the answer is I'm sure you all know, we don't abandon that because 84% of the time we get the outperformance over 10-year periods, a little less, but a majority over 5, and a majority, but even less because there's so much volatility year to year. So I just wanted to, when you see so much underperformance for so long in a category that we overweight, there might be a tendency to abandon the strategy, but we're going to stick with it for those reasons. So going back to in countries, this is always interesting to see developed countries, what's doing good and relatively poor. Switzerland at the top, Hong Kong, as you know, is in the news, has had the worst performance. And then in emerging markets, a lot of volatility with some very strong emerging market stocks and some very weak ones. We are increasingly using real estate, especially for retirees. And this is how real estate has performed over the period. And this bottom section here gives performance over longer periods of time. So we've had very strong performance lately. 1 year's a little less, 3 years, and then it smooths out over the longer period of time. It's a good diversifier, and it's a little bit less risky in some respects than equities. So we're moving some retirees funds over to that. This is always interesting. Everyone knows we usually hold about a 2% position in gold when, actually gold miners, when gold is undervalued in our opinion, and we tend to sell it when it rises and take profits. We've had a very good year in gold so far as we accumulated shares when it was down, and then now it's rallied. And this is the editorial that DFA produces, and it's basically saying something similar to the it's basically why we own stocks. This highlighted area is stocks outperform, equities outperform. They produce about 10% average yields, but the yearly yields vary widely from very, very high above 10% to very, very low below 10%. And when we endure these negative returns, the only way you can capture the average is to hang in there. So this breaks it down, with this chart, and then it does the math over 10-year periods. 94% of the time it's positive. So we haven't had a negative period. We're in a period where positive returns are tending to make people want to get more aggressive as the bull market gets older and older and the trend seems stronger and stronger. And the opposite is true. When the market gets lower and lower, people tend to abandon stocks. And what we really should be doing is the opposite. We're just trying to stay the course and make sure everyone is appropriately invested relative to their personal circumstances at all times. And we do tiny things on the margins, hedging, etc., to try to protect people that need it. But otherwise, we're just trying to stay the course. That is it for the summary. I hope you find it helpful. And if you have any questions, you're welcome to give me a call anytime. Thanks a lot. Bye-bye.